In 2019, a software engineer named David Chen walked into his Chase branch in San Francisco to dispute a $30 overdraft fee. The banker, barely looking up from her screen, told him the fee was policy and couldn't be waived. David had been banking with Chase for 8 years. 3 months later, David walked into the exact same branch to make a routine deposit. This time, the branch manager personally greeted him at the door, ushered him into a private office, offered him coffee, and spent 20 minutes asking how the bank could better serve his needs. During that conversation, the manager proactively reversed not just overdraft fees, but maintenance fees David didn't even know he'd been paying. She offered him a mortgage rate a full percentage point below what was advertised online and gave him a direct phone number that bypassed the 1-800 customer service line entirely. What changed in those 3 months? David's personality? His loyalty to the bank? His conversation skills? No. David had crossed an invisible threshold, a number that exists in every bank's internal systems, but that no banker will ever explicitly tell you about. A line that, once crossed, fundamentally alters how the entire financial institution treats you. And here's the thing that should make you furious. David didn't know this threshold existed. Nobody told him. He crossed it by accident while saving for a house down payment, and only then did he realize that for 8 years, he'd been playing a completely different game than the customers the bank actually cared about. My name is Tom, and I've spent an unreasonable amount of time reverse engineering how banks actually categorize their customers, not what they say in their marketing materials, but what their internal systems actually do when they evaluate your account. And what I've discovered is that there are exactly 3 net worth thresholds where everything changes. 3 specific numbers where you move from one category to an entirely different one in the bank's database. And each transition unlocks treatment, services, and leverage that are literally invisible to people below that threshold. If you've ever felt like the financial system was designed to keep you running in place, if you've ever wondered why some people seem to get incredible deals while you're nickel and dimed with fees, subscribe and like this video. Because by the end, you're going to understand exactly where these thresholds are, why banks will never advertise them, and what specifically changes when you cross each one. I'm going to show you the exact dollar amounts that separate retail banking from private banking from family office services. I'm going to explain why your bank actually loses money on you below a certain threshold and becomes desperate to keep you above another. And I'm going to give you the specific tactical moves you need to make at each stage. Not generic advice about saving more, but actual concrete actions based on where you are right now. But first, I need to take you back to Florence in 1397. Because what happened in Renaissance Italy explains exactly why modern banks operate this way, and why they'll never tell you these numbers exist. Let me tell you about the Medici Bank in the early 1400s. Now, you might be wondering what a 600-year-old Italian banking family has to do with your Chase or Bank of America account today. Everything. Because the Medici figured something out that every modern bank still uses, a system so effective that it's been refined and optimized for 6 centuries. Here's what they discovered. Not all customers are equally valuable. In fact, some customers are actively unprofitable. A small account requires the same infrastructure, the same ledger entries, the same staff time, the same physical space as a large account, but generates a tiny fraction of the revenue. Giovanni di Bicci de' Medici, the founder of the Medici banking empire, realized that if he treated every customer the same, his most valuable clients would leave for competitors while he wasted resources on unprofitable ones. So he did something revolutionary. He created tiers, not official tiers that he advertised. That would be crass, that would alienate the smaller customers. But internal tiers, secret categorizations that determined who got access to his personal attention, who got favorable loan terms, who got their requests handled immediately versus who waited. And here's the genius part. He identified specific wealth thresholds where a customer's profitability fundamentally changed. Below a certain amount, you cost the bank money. Above a certain amount, you made the bank money. And above an even higher amount, you became so valuable that the bank would do almost anything to keep you. The Medici documented these thresholds in internal family correspondence. Letters between Giovanni and his son Cosimo describe 3 distinct categories of clients, each requiring completely different treatment, different terms, different levels of access. The families who understood which category they were in and behaved accordingly often prospered for generations. The families who had wealth but didn't understand these invisible boundaries, they made catastrophic mistakes. They demanded treatment they hadn't earned yet, or worse, they failed to demand treatment they absolutely deserved. This system worked so well that it spread to every major bank in Europe, and then to every bank in the world. And then it got buried under layers of marketing language and "we value all our customers equally" corporate speak. But the thresholds are still there. They're just invisible now, encoded in software, expressed through algorithms, never explicitly stated. Your bank has you categorized right now. There's a flag in their system that determines everything from how quickly your customer service calls get answered to whether a human or a bot reviews your loan application. And that flag is determined by one thing: specific net worth thresholds that you've either crossed or you haven't. So why do these thresholds exist? What's the actual mathematical and operational reason that banks treat people so differently at different wealth levels? It comes down to a brutal economic reality that banks will never admit in their marketing. Below a certain amount, you are a cost center. You cost the bank more to service than you generate in revenue. Your checking account requires infrastructure, FDIC insurance fees, customer service resources, fraud monitoring, and regulatory compliance. If you keep $3,000 in your checking account, the bank might make $30 per year off you in various fees and from lending out your deposits. That doesn't even cover the cost of the infrastructure required to maintain your account. But at a certain threshold, you flip from cost center to profit center. Your deposits become meaningful. The bank can lend out your $100,000 at 6% while paying you 0.5%, pocketing the difference. They can sell you investment products with management fees. They can offer you loans at rates that generate real revenue. You're no longer a charity case they tolerate, you're a customer who actually contributes to the bottom line. And then there's a third threshold where you become so valuable that you flip from customer to asset. You're not just profitable, you're someone they cannot afford to lose. Your deposits are large enough that if you left for a competitor, it would show up in the branch's monthly numbers. Your investment accounts generate enough in fees to pay someone's salary. At this level, the bank assigns you a dedicated relationship manager whose job is literally just to keep you happy. Here's what most people don't realize. These aren't arbitrary categories. They're based on specific financial calculations that every major bank has done. There are exact dollar amounts where the math changes, where the profit and loss statement flips, where the risk assessment algorithms categorize you differently. And I'm going to tell you exactly what those numbers are. The first threshold, the one that changes everything, is $100,000 in liquid, investable assets held at the institution. Not $100,000 total across all your accounts everywhere. Not $100,000 including your car and your retirement account at your old job. $100,000 at one specific bank and accounts they can actually see and measure. Checking, savings, CDs, brokerage accounts, IRAs held with them. At $100,000, something fascinating happens in the bank's internal systems. You cross from retail banking into what many institutions call preferred banking, or priority banking. The exact name varies. Chase calls it Chase Private Client, Bank of America calls it Preferred Rewards, Wells Fargo calls it Portfolio by Wells Fargo, but the threshold is remarkably consistent across institutions, somewhere between $75,000 and $100,000 in combined balances. Here's what specifically changes the moment you cross this line. First, fees start disappearing. That $12 monthly maintenance fee on your checking account, waived. The $35 overdraft fee that they wouldn't budge on, suddenly negotiable, often waived with a single phone call. ATM fees, wire transfer fees, cashier's check fees, many of them vanish. Why? Because the revenue you're generating from your deposits and investments now exceeds the cost of providing you these services for free. You've become profitable so they can afford to treat you better. Second, you get access to actual humans. Below this threshold, you call the 1-800 number and navigate an automated phone tree designed to make you give up before reaching a person. Above this threshold, you get a direct line to a priority banking team with dramatically shorter wait times. Some institutions give you a dedicated banker, not someone who manages just your account, but someone who knows your name and has an incentive to keep you happy. Third, loan applications get processed differently. Not just faster, differently. Below the threshold, Your mortgage application goes into an automated system that checks boxes and calculates ratios. Above the threshold, a human underwriter looks at your full relationship with the bank. You have deposits with them, investments with them, a history of responsible banking. That context can make the difference between approval and denial, between a good rate and a great rate. Fourth, and this is subtle but powerful, you gain negotiating leverage. When you call to open a CD or ask about mortgage rates, the person on the other end of the phone can see your total relationship with the bank. They know you're a profitable customer. They have discretion to offer you better terms than what's advertised because keeping you happy is worth more than squeezing an extra quarter point of interest from you. But here's the psychological shift that matters even more than the practical benefits. Once you cross this threshold, you stop feeling like a supplicant begging for favors. You start to feel like a customer with options, and that feeling changes how you interact with the bank, which changes the results you get. Think about David from the beginning. For 8 years, he approached his bank like someone who needed them more than they needed him. He accepted fees as inevitable. He didn't negotiate. He didn't ask for better terms. Why would he? He was just a regular customer. But the moment he crossed $100,000, the power dynamic shifted. He didn't even know it had shifted, but the bank systems knew. And suddenly, opportunities appeared that hadn't existed before. Now you're probably thinking, okay, $100,000 sounds great, but how is that achievable for someone who isn't already wealthy? And this is where I need to be brutally honest with you, because this is where most people give up, and it's exactly where the banks want you to give up. Getting from $0 to $100,000 is the most difficult, most discouraging, most painfully slow part of the entire wealth building journey. If you're starting from scratch with a median income, this is going to take you somewhere between 7 and 10 years of consistent, disciplined saving and investing. 7 to 10 years, not 7 to 10 months, not 2 or 3 years if you're really disciplined, an entire decade of delayed gratification. Let me show you the math so you understand why it feels so hopeless. If you're saving $800 a month, which requires real sacrifice for most people, that's $9,600 per year. In your first year, even if you're getting 8% returns in the market, you'll end the year with maybe $2,100. You put in $9,600 of your own money and the market gave you $500. Your effort contributed 95% of the growth. The compound interest everyone talks about contributed 5%. In year 2, you add another $9,600. You now have about $20,800. The market contributed maybe $100 this year. Still not impressive. You're putting in $800 a month and watching the number creep up so slowly that it feels pointless. This is the puddle phase. This is where you're pouring water into a pool and creating a puddle that spreads across the bottom, evaporating in the sun faster than it's accumulating depth. Year 3, year 4, year 5. The same story. You're contributing almost all the growth. The investments are helping technically, but you can barely feel it. Your balance might show $35,000, then $48,000, then $62,000. It's growing, yes, but so slowly that every unexpected expense, every market downturn, every moment of doubt makes you want to quit. And this is exactly where 90% of people stop. They do the math. They see that at this rate, it'll take another 4 or 5 years to reach $100,000. They decide it's not worth it. They buy the nicer car instead. They upgrade to the bigger apartment. They tell themselves they'll start seriously saving later, when they're making more money, when it'll be easier. But here's what they don't understand, what the banks absolutely don't want them to understand. The acceleration is coming. In year 7, you might have $78,000. You add your $9,600 for the year, but now the market contributes $6,200. Suddenly, the market is contributing 40% of your annual growth instead of 5%. You can feel it now. The balance isn't just creeping anymore, it's moving. Year 8, $95,000. You add your $9,600, the market adds $7,600. You break through $100,000 sometime in year 9, and the moment you cross that threshold, everything you just suffered through starts to make sense. Because here's what happens next, and this is where the math becomes almost unfair. Getting from $100,000 to $200,000 takes roughly half as long as getting from $0 to $100,000. Not because you suddenly got a massive raise, not because you started saving twice as much, but because now your money is doing meaningful work. At 8% returns, your $100,000 generates $8,000 per year automatically. You're still contributing your $9,600 from your paycheck. That's $1,700 of annual growth, nearly double what you were achieving in the early years. The snowball that you've been struggling to get rolling is finally rolling. And it's picking up speed. The people who build serious wealth aren't the ones with the highest incomes or the best investment strategies. They're the ones who survive the puddle phase. They're the ones who keep showing up month after month, year after year, contributing their $800 even when it feels meaningless. They're the ones who resist the urge to quit in year 5 when the progress feels pathetic. And once you cross that first threshold, once you hit $100,000 and the bank systems flag you as a preferred customer, you're not just wealthy in dollars. You're wealthy in options. You're wealthy in leverage. You're wealthy in the way the financial system starts treating you. But $100,000 is just the beginning. It's the threshold that gets you noticed. The second threshold is where you gain something far more valuable: immunity. The second net worth threshold that fundamentally changes your banking relationship is $500,000 in liquid investable assets. And at this level, you cross into what banks internally call private banking or wealth management services. At most major institutions, $500,000 is the entry point for true private banking. Some set it at $250,000, some at $1 million, but $500,000 is the sweet spot where the transition typically happens. Here's what changes, and I want you to understand that these aren't incremental improvements. This is a categorical shift in how you're treated. First, you're assigned a dedicated private banker or wealth advisor, not a call center representative, not a branch employee who helps dozens of customers per day. A specific person whose compensation is partially tied to your satisfaction and retention. This person has their own phone number. They respond to emails. They remember your name and your goals. If you call them on a Friday afternoon with a question, they answer because losing you costs them personally. Second, you get access to products and services that literally aren't available to retail customers. Private banking clients can often get mortgage rates that are better than advertised rates. They can access credit lines with better terms. They can get jumbo loans approved faster with less documentation because the bank sees the full relationship. You're not just a mortgage applicant, you're a wealth management client who happens to need a mortgage. That changes everything. Third, fees become essentially negotiable. Most fees can be waived with a conversation. Wire transfer fees, foreign transaction fees, account maintenance on multiple accounts, all of it becomes fluid. The bank's revenue from your deposits and investment accounts is substantial enough that they'd rather keep you happy than collect $50 in wire fees. Fourth, and this is where it gets really interesting, you start to get offers you didn't ask for. The bank starts coming to you with opportunities. We have a new structured product that might fit your portfolio. Interest rates on CDs are going up. We wanted to let you know before we advertise it publicly. We noticed you have a large cash position. Would you like to discuss laddering some treasuries? You've become important enough that they're actively managing the relationship rather than waiting for you to ask for things. But here's the psychological transformation that matters more than any of these tactical benefits. At $500,000, you develop what I call banking immunity. You become functionally immune to the types of financial emergencies that destroy most people. Think about what this means practically. You could lose your job tomorrow. You could get laid off, fired, have your entire industry collapse. And yes, it would be a problem. Yes, you'd need to find new income eventually, but it wouldn't be a catastrophe. You wouldn't lose your house. You wouldn't go hungry. You wouldn't have to take the first terrible job that comes along just to keep the lights on. Using a conservative 4% withdrawal rate, $500,000 generates $20,000 per year in passive income. That's not luxury. That's not even comfortable in most expensive cities, but it's the floor of survival. It's rent in an affordable market. It's food, utilities, basic transportation. It's breathing room. And breathing room changes everything about how you negotiate with the world. When you walk into a job interview, you're not desperate. When your boss makes unreasonable demands, you can push back. When a client tries to lowball you, you can walk away. You have what I call walk-away power, the ability to say no without facing catastrophic consequences. And here's the paradox. The moment you don't need the job desperately, you become better at getting jobs. You interview with confidence. You negotiate harder. You set boundaries. Employers can sense it. You stop giving off the subtle desperation signals that make them offer you less. At $500,000, your relationship with your bank transforms from customer to valued client. But your relationship with work, with risk, with opportunity, those transform even more dramatically. The bank notices you've crossed the threshold and upgrades your treatment. But more importantly, you notice you've crossed the threshold and you upgrade your own behavior. Now, you might be thinking, $500,000 sounds impossibly far away. This is fantasy territory for someone like me. And I understand that reaction. When I first mapped out these thresholds years ago, I was sitting at maybe $30,000 in total savings, feeling pretty good about myself. And the idea of $500,000 seemed like something that happened to tech entrepreneurs and trust fund beneficiaries, not regular people with regular jobs. But remember the acceleration principle I mentioned. Getting from $0 to $100,000 might take you 8 or 9 years. Getting from $100,000 to $500,000 typically takes another 10 to 12 years if you maintain the same savings rate. That sounds like a long time, and it is. But that time is going to pass regardless. Here's the math. If you have $100,000 and you're contributing $800 per month and earning 8% returns, you'll hit $500,000 in about 12 years. But your $100,000 isn't just sitting there anymore. It's generating $8,000 per year automatically. You're contributing $9,600 per year from your paycheck. That's $17,600 in annual growth right from the start. As the balance grows, the automatic contribution grows with it. At $200,000, the market is contributing $16,000 per year while you're contributing $9,600. Your money is working harder than you are. At $300,000, the market contributes $24,000 per year. Your money is now your most productive employee. The families who understand these thresholds, who actually cross them and internalize what it means, they start making completely different decisions. They stop worrying about maximizing every paycheck because their capital is handling survival. They start thinking about equity, ownership, long-term growth because they have the security to take intelligent risks. But here's where people sabotage themselves, and I watched this happen to countless people during the 2008 financial crisis. They cross the threshold without understanding what they've crossed. They have the money, but not the mindset. In 2008, I knew people who had $500,000 or more in retirement accounts. They had done the saving, they had checked the boxes, they were objectively at the second threshold. But when the market dropped 40%, when their statements showed $300,000 instead of $500,000, they panicked. They sold everything. They converted a temporary paper loss into a permanent realized disaster. Why? Because they still thought of themselves as vulnerable. They still operated from scarcity. They had reached the second threshold without psychologically internalizing what it meant. They reacted like someone with $20,000, not someone with a fortress that could weather temporary storms. The shift at $500,000 isn't just about what the bank offers you. It's about what you believe about yourself, about your security, about your ability to weather volatility. If you cross this threshold without updating your mental model, you'll sabotage yourself at exactly the wrong moment. This brings me to the third threshold, the one that separates the wealthy from everyone else, the line that fundamentally changes your relationship not just with banks, but with time itself. The third net worth threshold is $2.5 million in liquid investable assets. And at this level, you enter what banks call family office or ultra-high net worth services. This is a completely different banking universe. We're not talking about better customer service anymore. We're talking about bespoke financial infrastructure built around your specific needs. Here's what $2.5 million unlocks. First, you get access to institutional-grade investment opportunities that retail clients can't touch, private equity funds with $250,000 minimums, pre-IPO investments, structured products designed for ultra-high net worth individuals, hedge fund access. These aren't necessarily better investments, but they're different asset classes entirely, unavailable below this threshold. Second, you're assigned a team, not a person. A relationship manager, a trust officer, an estate planning specialist, a tax strategist. These people coordinate with each other. They have meetings about your account. Your financial life becomes their professional focus. Third, banks will structure custom solutions. Need a loan with unusual terms? They'll create it. Want a multi-currency account with specific features? They'll build it. At this level, you're not choosing from a menu of products. The bank is designing products around your needs. Fourth, and this is where it gets almost surreal, banks will actively compete for your business. You'll get phone calls from private banking groups at other institutions trying to lure you away. They'll offer incentives, bonus interest rates, fee waivers for years, cash bonuses just for moving your accounts. You're not a customer anymore. You're a prize. But here's what actually changes at $2.5 million. The thing that makes this threshold fundamentally different from the previous two. At $2.5 million, using a conservative 6% return, you generate $150,000 per year in passive income. For most people in most places, that's more than their working salary. Your capital is now more productive than your labor. Every hour you spend working for money is actually an inefficient use of your time. This is what I call the inversion point. Below this threshold, your time is your most valuable asset. Every hour you work generates more wealth than your capital does. Trading time for money makes perfect sense, but above the inversion point, the equation flips. Your capital generates more wealth than your time possibly can. Think about what this means. If your investments are producing $150,000 per year, that's roughly $410 per day, every day, including weekends. If you work an 8-hour day at a job that pays you $300 for those hours, you've actually lost money economically. You would have been better off spending those 8 hours optimizing your capital deployment or doing literally nothing and letting the money work. This is why truly wealthy people behave so differently. It's not that they're lazy, it's that they've done the math. For them, traditional employment is a bad trade. It's accepting payment in a currency worth less than what they're giving up to earn it. At this threshold, banks don't just treat you differently. They genuinely need you. Your deposits are meaningful enough that if you left for a competitor, it would impact the branch's numbers. Your investment accounts generate fees that justify multiple employees' salaries. The bank will absorb costs, waive fees, offer custom terms, anything to keep you. But here's the uncomfortable truth that most people don't want to hear. The path from $500,000 to $2.5 million almost never comes from salary alone. The math doesn't work, no matter how impressive your income sounds. If you're saving $50,000 per year, which is already aggressive and unachievable for most people, and you're starting from $500,000 with 8% returns, it takes roughly 18 years to reach $2.5 million. 18 years of maximum intensity saving and investing. Most people who cross the third threshold do it through ownership. They own part of a business that succeeds. They own real estate that appreciates significantly. They own equity in a company that exits. They own something that grows faster than their ability to save. This is the lesson that the financial industry will never teach you because it breaks their entire model. Their model is save 15% of your income, invest in diversified index funds, retire at 65 with maybe $1 million to $2 million if you're disciplined. That's designed to get you to threshold 2, not threshold 3. That's designed to make you secure, not wealthy. And there's nothing wrong with security. Threshold 2 is an enormous achievement that most people never reach. But if you want to cross the inversion point, if you want to reach the level where banks actively compete for you and your capital works harder than you possibly can, you need to think differently. You need ownership. You need equity. You need something beyond wages. Now, let me tell you who benefits from your ignorance of these thresholds. Because this isn't an accident. This isn't information that just happens to be obscure. It's deliberately hidden. Banks make enormous profits from customers who don't understand these thresholds. Think about their business model. They want you to keep large balances in checking and savings accounts that pay essentially zero interest, while they lend that money out at 6%, 8%, 10%, or more. They want you to carry credit card balances at 18% to 24% APR. They want you to take out auto loans, personal loans, mortgages, all at rates that generate profit for them and delay wealth building for you. Every dollar you keep in a checking account earning 0.01% interest is a dollar that could be invested earning 8% on average. That gap, that 8% difference, that's the bank's profit margin. They're using your money to make money while paying you essentially nothing for the privilege. And here's the insidious part. The fee structures at most banks are specifically designed to punish small accounts and reward large ones. Monthly maintenance fees of $12 or $15 are waived if you maintain a minimum balance of, you guessed it, often around $100,000 in combined accounts. Overdraft fees of $35 hit people living paycheck to paycheck, people who can least afford them, while customers with large balances get them waived automatically. The bank loses money on you below the first threshold. They make money on you between the first and second threshold. They make enormous money on you above the second threshold. So their entire incentive structure is designed to keep you below the first threshold or to extract maximum fees from you if you're between thresholds. Your employer benefits from your ignorance too. Think about it. If you don't know that $500,000 gives you walkaway power, you'll stay in jobs that underpay you. You'll tolerate poor treatment. You'll accept minimal raises. You'll work unpaid overtime because you need this job. You can't afford the risk of leaving. But if you understand these thresholds, if you're actively working toward $100,000 or $500,000, you start to see your job as temporary, as a means to an end, not the end itself. And that shift in perspective changes how you negotiate, how you advocate for yourself, how you tolerate being treated. The financial media benefits from your confusion. Their business model depends on you being anxious, uncertain, constantly clicking on articles about the next hot stock tip or the coming market crash. If you understood that reaching $100,000 is more important than which tech stock to buy, if you understood that getting to $500,000 eliminates most financial anxiety, regardless of market conditions, you'd stop clicking. You'd stop watching. You'd focus on the boring, unsexy work of consistent saving and investing rather than trying to outsmart the market. They keep you focused on income because income is exciting. Income is something you can optimize, negotiate, compare with your peers. But income is what flows through you. Net worth is what stays with you. Someone earning $150,000 and spending $140,000 has less wealth building power than someone earning $70,000 and spending $50,000. But we celebrate the first person and pity the second. They push products and lifestyles that prevent you from reaching these thresholds. New car every few years, bigger house as soon as you can qualify for the mortgage, premium subscriptions, upgraded phones, lifestyle inflation that absorbs every raise before it can become savings. These patterns are engineered by industries that profit from your consumption. Every dollar you spend on a car payment is a dollar that isn't compounding toward $100,000. Every dollar that goes to a bigger house than you need is a dollar that isn't working toward $500,000. The companies selling you these things know this. They want to capture your increasing income before it can become increasing wealth. And perhaps most insidiously, they make the first threshold feel impossible. Remember, getting to $100,000 is the hardest part of the entire journey. If they can convince you it's not worth trying, if they can make you feel like the game is rigged and only people who are already rich or lucky can build wealth, then you'll stop playing. You'll give up before you start. You'll tell yourself you'll save later when you make more money, when the timing is better. And as soon as you stop playing, as soon as you give up on reaching these thresholds, you become a permanent customer instead of a future competitor. You'll borrow from them forever. You'll pay fees forever. You'll stay dependent forever. So what does this actually mean for you? What can you do with this information starting today? First, you need to calculate exactly where you are relative to these three thresholds. Not roughly, not somewhere around. Exactly. Open every account you have, every brokerage account, every 401k, every IRA, every investment app. Add up everything that's invested in assets that can grow. Stocks, bonds, index funds, ETFs, real estate investment trusts. Don't count your car. It's depreciating. Don't count your furniture or electronics. Don't count the equity in your primary residence. That's complicated and illiquid. And we're talking about assets you can actually leverage with banks. What's the number? Write it down. Be brutally honest with yourself. This is your starting point. If you're below $100,000, you have one mission. Get to $100,000 as fast as humanly possible. Nothing else matters right now. Not optimizing your asset allocation between US and international stocks. Not finding the perfect low-cost fund with a 0.03% expense ratio instead of 0.05%. Not worrying about tax loss harvesting or backdoor Roth conversions or any of the advanced strategies you read about online. Just get to $100,000. This means cutting expenses ruthlessly. Look at your last 3 months of spending and identify everything that isn't truly essential. I'm not talking about extreme deprivation. I'm talking about being honest about what you actually need versus what you've convinced yourself you need. This means increasing income however you can. ask for a raise. If you haven't asked in the last year, you're leaving money on the table. Take side work if possible. Sell things you don't use. Every extra dollar you can generate goes straight into investments. This means automating everything. Set up automatic transfers from your checking to your investment accounts the day after your paycheck hits. Make the money move before you can spend it, before you can rationalize that you deserve a reward or that you'll invest it next month. Treat it like a bill that must be paid, because it is. You're paying your future self. Survive the puddle phase. This is going to take years. It's going to feel slow and pointless and frustrating. You're going to want to quit. Don't. Every month you keep contributing, you're 1 month closer to the threshold where everything changes. If you're between $100,000 and $500,000, your focus shifts. You've proven you can build wealth. Now you need to protect it while letting it grow. This means building a real emergency fund, 6 months of actual expenses, not the bare minimum, real expenses. You're starting to have something worth protecting. This means making sure you're properly diversified, not too much in any single investment. If you work for a publicly traded company, don't let company stock become more than 10% to 15% of your portfolio. I've seen too many people build significant wealth and then lose it because they were over-concentrated in their employer's stock. This means starting to think seriously about what walk-away power would mean for your career. Could you leave your job tomorrow if the environment became toxic? If not, what's the gap? How much more do you need to save? What would it take to get to 6 months, a year of expenses covered by your investments? Use your growing leverage with banks. If you're over $100,000, call your bank. Ask what programs they have for preferred customers. Don't wait for them to offer. They won't always do it automatically. Tell them you're considering moving your accounts to a competitor who's offered you better terms. See what they can do. Negotiate. You have leverage now. Use it. If you're between $500,000 and $2.5 million, your strategy changes again. You're secure. You have walkaway power. The question now is how to get to the inversion point, and the answer is almost always ownership. How can you get equity in something that grows faster than public market returns? Maybe that means starting a side business and actually trying to scale it instead of keeping it as a hobby. Maybe it means negotiating for stock options or RSUs if you work at a growing company. Maybe it means investing in real estate beyond your primary residence, income-producing properties where you own something that appreciates and generates cash flow. Maybe it means angel investing in startups if you have the expertise and risk tolerance. Maybe it means partnering with people who are building businesses and providing capital in exchange for equity. Whatever it is, the third threshold rarely comes from salary alone. You need to own something. And if you're above $2.5 million, congratulations. Seriously, you've crossed the inversion point, but this is also where people make their biggest mistakes. The temptation to take enormous risks increases dramatically when you feel wealthy. People start chasing exotic investments. They make concentrated bets. They try to turn their $2.5 million into $10 million quickly. And this is often exactly how people fall back below the threshold, sometimes all the way to the beginning. The goal at this stage isn't rapid growth. It's intelligent preservation and measured deployment. Diversify properly. Don't get clever. Think about legacy and sustainability, not moonshots. Let me bring this back to where we started, because the real lesson here isn't about specific dollar amounts. It's about understanding that the game changes as you cross each threshold. Remember David Chen, the software engineer who walked into Chase? For 8 years, he didn't know these thresholds existed. He played the game without understanding the rules. He accepted fees as inevitable. He didn't negotiate. He thought the financial system treated everyone the same, but it doesn't. It never has. Going back to the Medici in Renaissance Florence, banks have always categorized customers into tiers. They've always treated people differently based on wealth thresholds. The only thing that's changed is that modern banks have gotten much better at hiding it, at pretending everyone's equal while internally running completely different systems for different tiers. The families who prospered for generations in Renaissance Italy weren't necessarily the ones who started with the most money. They were the ones who understood which threshold they'd crossed and what rules applied at that level. They didn't make stage 1 decisions when they had stage 2 money. They didn't act like they were still vulnerable when they'd actually built real security. The families who disappeared, who faded away within a generation or two despite having wealth, they made the opposite mistake. They had money, but not understanding. They crossed thresholds without updating their mental models, and it destroyed them. The same thing happens today. I've watched people reach $100,000 and then immediately increase their lifestyle expenses to match, preventing themselves from ever reaching $500,000. I've watched people cross $500,000 in panic during market downturns, selling at the bottom and destroying what took them decades to build. I've watched people reach 2.5 million and then take massive concentrated risks, chasing the next threshold so aggressively that they fall all the way back. The thresholds are just numbers. What matters is whether you internalize what each threshold means, what new rules apply, what behaviors need to change. At $100,000, you stop being invisible to your bank. You gain leverage and options. At $500,000, you gain security and walk-away power. Your relationship with work fundamentally changes. At $2.5 million, you cross the inversion point where your capital works harder than you possibly can. These aren't just financial milestones. They're psychological transitions. They're identity shifts. And if you don't make those mental transitions along with the financial ones, you'll sabotage yourself. The financial industry will never tell you these numbers exist because it contradicts their entire marketing strategy. They want you focused on products, not thresholds, on returns, not net worth, on complexity, not simple, consistent accumulation. The media won't tell you because this information doesn't generate clicks. It's boring. It takes years. There's no secret hack, no overnight success story. Your employer won't tell you because your desperation benefits them. The less you know about walkaway power, the more they can extract from you. But now you know. You understand the 3 thresholds. You know exactly what changes at each one. You know why banks treat people differently, even while claiming they don't. You know that the journey to the first threshold is brutal and slow and the exact point where most people quit. You know that crossing each threshold requires not just accumulating money, but updating your mental model of what that money means and how you should behave. The question is, what are you going to do with this information? Are you going to keep playing the game the way the banks want you to play it, borrowing from them, paying fees to them, staying dependent on them? Or are you going to play the game the way the Medici played it 6 centuries ago, understanding the thresholds, positioning yourself strategically, and using each threshold you cross as leverage to reach the next one? The choice is yours, but at least now you can see the game board clearly. You know where the boundaries are. You know what you're working toward and why it matters. If this video changed how you think about money and banking, hit subscribe. Drop a comment and tell me which threshold you're working toward right now. I read every single comment and I'm genuinely curious where you are in this journey and what strategies you're using to get to the next level. The thresholds are real. The math is real. The different treatment is real. Now you just have to decide whether you're going to survive the puddle phase and actually cross them.